So before I actually jump into the content, a quick introduction. My name is Yogesh. I'm a chartered accountant by qualification. I've got a total of 15 years of post qualification experience, and I started my career into equity research with one of the leading MNCs, and after that I started my own consulting firm, and I've also got into training. So for the last 9 years I've been training students for various courses, like CFA, financial modeling. I've trained for ACCA and CIMA as well. Okay, now all these questions are gathered from basically my own understanding of the industry, how I generally take interviews, of how my students who have gone through the interview process in the last few months or so, or maybe a couple of years or so, what kind of questions they have been asked, and based on that we have created a few questions that are there. Okay, now before I again jump into the question, we need to just categorize the kind of questions that you are likely to get in an investment banking equity research interview. The first set of questions would be the general questions. This is not necessarily in the sequence, but generally they ask you, walk me through your resume, tell us about yourself, those kind of questions to get you started with this. Why do you want to get into investment banking or equity research? Those kind of questions. We're not going to cover them today. We are going to only focus on the technical questions. The technical questions, if you see, are broadly in the three categories or four categories, I would say. One is the accounting questions that are there. Then you will get the valuation and finance related questions that are there. The third set of estimate, the questions that you get is on guess estimates. We will look at some of the guess estimates. And finally, there could be a set of questions coming on Excel. Okay, just basic Excel. Most of these interview will have some kind of case study, right? So ideally your Excel would have been tested with the case study, but if it is not there, or if they want to test you further, then you may also have questions related to Excel. Okay, so we will first get started with the accounting related question. And this is the one that a lot of people get it wrong. When we say what is goodwill, most of the people will say it is uh, the worth of the company. It is how much the company is valued by the customers and all those things. That is not goodwill. For all accounting purpose, what is goodwill? Goodwill is the excess paid over net assets acquired. What do we mean by that? What do we mean by that? Basically, let's say you are acquiring a company. Company A is acquiring company B. Okay, and company A is paying $100 million or 100 crores for company B, right? Now, let's say the net asset. What is the net asset of a company? It is basically equity minus, sorry, net assets is assets minus liability, right? Which is also equal to equity, which is also called as net worth. Some people call it book value. And this, so basically what we take is the value of the equity. Now this is not the book value, it's ideally the market value of equity. So let's say the net assets of the company is 80 and you are paying 100 to acquire this company. The additional 20 that you paid is goodwill, right? This is how you will have to define goodwill for accounting purpose. You should not say that it is the worth of the company. It is how the customers value and all those things is not required and is not taken as the right answer. Next, what is contingent liability? Now, again, the name itself is slightly misleading. because this is not a real liability, right? It is basically something which is not a liability today, which will become a liability if a certain event happens or not happens, right? For example, the best example that we give for a contingent liability is a court case. So let's say, a company A has filed a case against company B saying that you have infringed one of my patents and you will have to pay me, $1 million, right? So company b company B, which is liable to pay at this point, is not liable to pay because it's not lost the court case, right? So company B will in its notes of accounts or notes to accounts write a statement saying that such a liability may arise in the future if we lose the case, right? So contingent liability is not a real liability. It is a liability which may arise because of a certain event happening or not happening. And also, contingent liability is not recorded in the books of accounts. It is just stated in the notes to accounts, just as an information for the investors. Another one where a lot of people get stuck: what is deferred taxes? Now deferred taxes is basically the timing difference, or the timing difference multiplied by the tax rate. Timing difference multiplied by the tax rate. Now what is timing difference? The timing difference is basically there is a difference between how you calculate the profit as per books of accounts and how you calculate profits as per taxes, right? The difference between them, those differences which are going to reverse in future, right? This is very important to say, which are going to reverse in futures. Those differences are taken and then the tax rate is multiplied to get the deferred taxes, right? It could be an asset or liability depending on the nature. So a few things that you need to say: timing difference is very important to say. The other thing that you have to say is reversible, right? Those timing differences which will adjust in the future or which are reversible will be only taken care in deferred taxes, right? We're not trying to make you accountants here, right? But you need to understand enough of accounting so that you can do financial modeling or financial analysis. Diluted EPS, another question a lot of people get stuck. At least this is a lot of people I have seen getting stuck with. What is diluted EPS? It is EPS calculated considering that all the convertible securities, right, which are going to convert in future have already got converted. Remember that we are not actually converting those securities. We are just calculating as if they have got converted, right? So diluted EPS is the EPS calculated after considering all the convertible securities that were there have got converted, right? What are convertible securities? Generally the convertible securities that you see in the books of accounts is convertible bonds or debentures. Convertible preference shares could be there, warrants could be there, stock options could be there. These are the things that will be treated as convertible securities. And what you will assume is the all the convertible securities have got converted, right? Have already got converted. That is what we will assume, and then do a calculation. Again, remember, it is just a calculation. We are not converting those securities at this point of time. One more question and then I go to people to check what given a choice. So this is again a question that I ask a lot of time, and I have seen a lot of people asking in the interview that among the three financial statement, which is the income statement, balance sheet and cash flow, right? If you have to choose only one of them, we understand that they are not complete without each other, but if you have to select one of them as an analyst, which one will you select and why? My answer is the cash flow statement. There are multiple reasons. The reason number one is that it is it is comparatively very difficult to manipulate the cash flow. The easiest one among the three statement to get manipulated or to be manipulated is the income statement. So income statement is definitely out of this race, right? Between the cash flow and the balance sheet, there is a close fight, but still the cash flow is the one which is least likely or very difficult to manipulate, right? That is reason number one. Reason number two is it helps us understand, where the company is generating money for and what is it doing with the money, right? It generally gives us the picture of the business of the company. It also tells us whether it's going to survive in the near future or not, whether it is able to generate enough cash flow to sustain in the near future. So as an analyst, if I have to still choose, I mean, I know that all three statements are not complete without each other, but if still I have to choose one of them, I will go ahead and choose the cash flow statement. Okay, we'll take a quick pause. So again, one more question on the accounting. There are a few more on the accounting. It says if the depreciation goes up by, so basically depreciation as expenses have gone up by 10,000. How would it affect the income statement? So you have to tell us what happens to the three statements. So what will happen to the profit or the income statement? The profit will fall by 10,000, but it will not fall exactly by 10,000 because there is an impact coming from tax, right? So let's say if the tax is 30%, let's say the tax is 30%, then the profit fall will be 10,000, right? And net of tax, which is 30%, which is 3,000. So the fall in profit will be 7,000, right? What happens to the cash flow statement? The cash flow statement, uh, you know, basically the impact of the taxes, right? Whatever lower taxes you pay, that much will be taken care in the cash flow statement. And the balance sheet, obviously the assets on the balance sheet will fall by 10,000, right? Assets on the balance sheet will fall 10,000. On the cash balance will also be coming from the cash flow statement that is there, and obviously the profits will come from the reserves, right? So this is broadly the impact on the balance sheet. So balance sheet will the asset side and liability side both will be impacted by 10,000. Is quite interesting because a lot of questions are being asked. There could be a lot of accounting red flags, right? What are accounting red flags? These are basically things that you can look at and say that potentially there is a manipulation of accounts happening, right? So there are so many things that you can find out, but one of the common things that I talk about when we say about accounting red flags is when the profits and the cash flow, right? Profits and the cash flow are very different from each other for a long period of time. What do I mean by that? Look at this example for the profit. So let's say my profit is for the 5 years, my profit is 1,000, right? Each year profit is constant, profit is not changing. My cash flow from operations is also, for every year it is 500, right? Now if this is the situation, then I am worried. If it is a situation for 1-2 years, then it is not a problem. But if it is such as the situation for a long period of time, then I have a problem. Now what is the issue here is that in the first year you earned or you made a profit is calculated based on accrual, right? So it will have cash component and the accrual component. So the cash out of it is only 500, which means the remaining 500 would be collected or would be coming to you at a later date in the next year potentially, right? But when you see the statement for the next year also, it is not coming to you, right? Subsequent also not coming to you subsequent. So whatever 500 was left over in the first year, you have still not recovered, or if you have recovered, I am assuming here, then the next year collection is zero, right? So if you have such a situation, which means that the profit and cash flow are very different from each other over a long period of time like this, then this is the most common or one of the most common accounting red flags. You can also talk about, if the inventory and the sales are growing at a very different rate from each other. That is another accounting red flag that is there. So many of them are there. I am just talking about a couple of them. Now this question, the way the question is structured, it says why current ratio of less than 1 is bad. honestly, current ratio of less than 1 may not be bad, right? But the way it is structured, you will always start speaking as if it is bad, right? Why do I say it is not necessarily bad? Because there are a set of companies for whom you will have a higher amount of current liabilities, which is in form of what do you say, advance collection from the customers, right? And then they use this for their own business, not necessarily in the short term but in the long term. So what will happen for such companies? The current ratio will be lower than 1. A good example is any of such platform like Amazon or Flipkart. So if you see, Amazon or Flipkart collects money from the customers, and that customers' money is kept with them for the next 30 days, right? Is kept with them for the next 30 days or 15 days, depending on what is the amount, how, when they pay to the sellers, right? Now, when this money is lying for them with them, let's say for 30 days, what will they do with this? Where will they show this money? It will be shown as current liability because they have to give it to the sellers. What will they do with this money? Is they will put this money into long term. Now, why will they put it into the long term, not short term? They will put it into the long term because they will always have this cycle rolling. And at any point of time, they will have 30 days worth of sales lying with them, or that much cash lying with them, and they will be using it for their long term business. So in such a case, it will be the current liabilities will be more, the current asset is less. This is not necessarily bad. Your customers have paid you in advance, or you are utilizing your suppliers money, which is free of cost for a long period of time. This also happens where, customers are paying you in advance most of the time. If you look at the prepaid for the telecom, if you see, you book your air tickets in advance, so these companies will have a huge amount of current liability with them, and because of that the current ratio will be maybe less than 1, which is not necessarily bad. The question that is thrown up generally also, and in the interviews also, what is the significance of EBITDA? Obviously, EBITDA stands for earnings before interest, tax, and depreciation. But what is the significance? If you look at how the DCF valuation works, DCF valuation, or a lot of people when they do not look at the cash flows. Right. One reason they don't look at the cash flows is that the cash flows are erratic in nature, right? So what they have done is they have found out a proxy to the operating cash flow in the income statement only, and that is the EBITDA, right? Earnings before interest, tax, and depreciation. So a lot of people use it as a proxy to operating cash flow. It is not necessarily the operating cash flow, but it gives you a fair idea about your operating cash flow. Remember, I could have taken the operating cash flow from the cash flow statement itself, but if you look at over a period of time, the trend, it is generally erratic. Most of the time, EBITDA is not necessarily erratic. One more question, and we then jump into checking with people if they have any other questions, or if they were not able to understand any part of it. So enterprise value and the equity value. So when we do, so this is where we actually have jumped into the questions related to um, finance or valuation, right? So what is enterprise value and equity value? So enterprise value is the value of the whole company, right? Typically, it is calculated as uh, I should actually just get this corrected. Right. So enterprise value is basically the value of equity plus debt, right? I have taken the cash, but I will tell you that later. But you have to understand it is the value of the whole company, including the value of equity and the value of debt, right? Or you should take it as net debt, right? Value of equity and value of net debt. And equity value is obviously only the value for the value for the equities, right? Why do we adjust cash? Cash is considered to be coming from the equity, and hence it is adjusted. Otherwise, they say it could be a double counting, right? So this is your enterprise value and the equity value, and the difference between the two. Enterprise value, you can think of equity plus debt, and Valuation methodologies that are generally used. So we generally come across the DCF valuation, right? The DCF, discounted cash flow valuation, and the relative valuation, right? Within the relative valuation, you have got two components, which is comparable company and the comparable transaction. What is comparable company? In the relative valuation for comparable companies, what you find out is, similar listed companies that are available. For them, you find out the multiple, right? So let's say we are using the EV by EBITDA multiple. So you will find out EV by EBITDA multiple for comparable companies which are listed, and you will get their data, right? That is called as comparable company. In comparable transaction, you look at any transaction, any M&A, mergers, acquisition, or any investment transaction that has happened in a similar company or in a similar industry, and what was the multiple for that particular transaction, right? So within the relative valuation, we use the two sets of multiple: comparable companies and comparable transactions. How do you calculate the terminal value? So there are two ways generally we use for calculating the terminal value. One is to calculate the present value of a growing perpetuity. So let's say we take the free cash flow for the fifth year. Let's say we have forecasted for 5 years. So we take the free cash flow for the 5 years, one plus the growth rate. So this is the growth rate at which the company is going to keep growing for foreseeable future, divided by weighted average cost of capital minus the growth rate. This is nothing but present value of a growing perpetuity. Present value of a growing perpetuity. This is one way of doing the terminal value. The other way of doing the terminal value, or other way to calculate the terminal value, is to use the exit multiple, right? So you can say that when at after 5 years, when somebody who has invested in the company exits, at what multiple he will exit, right? So you can use, let's say, we a lot of time we use the EV by EBITDA multiple. So you can say EV by EBITDA multiple at that point of time will be 8x, right? So whatever is your EBITDA multiplied by 8, that is your terminal value, right? This directly gives you the present value of the terminal value. This you will have to bring it to the present value. So two ways to calculate the terminal value. By the way, what is terminal value? It is the value of the company beyond the explicit forecast periods, right? So when we do a financial model, we generally forecast for 3, 5, or 7, 10 years. And beyond that, the company will still be there. So we take the cash flows of that, and then we calculate what is called as terminal value. I have seen this question in every interview that people have gone through, or any interview that I have taken for equity research or investment banking profile. Run me through DCF, right? So when somebody is asking you to run through DCF, they're just trying to say how will you structure the DCF, right? You don't have to say that, okay, I just get the cash flow, I discount the cash flow, and I get the stuff. What they're expecting is a bit of elaboration for that. So you can say that we start with EBIT and then 1 minus tax rate, right? To this we add depreciation less capital expenditure, capex, plus minus changes in working capital. What you will get is the free cash flow to the firm, right? Free cash flow to the firm. So you may get free cash flow to the firm for the explicit period, let's say 5 years. After that, you will calculate the terminal value. You will take all these cash flows, and discount it using the weighted average cost of capital, discount it using the weighted average cost of capital. And what you get is called as the enterprise value. From the enterprise value, you deduct net debt. You will get equity value, right? And then divided by the number of shares, you get the target price or the share price. So what you need to remember is that you need to tell them this is how we do, right? They may have further questions on these sets. That is why they are potentially asking you to run me through the DCF. Okay. Next is what is beta and how to calculate beta for private company. To give you just this, what is beta? Beta is basically a measure of risk, right? Measure of risk, right? What is the kind of risk that we are measuring with beta? We are measuring systematic risk. What is systematic risk? Any risk that cannot be overcome or avoided through diversification is called as systematic risk, right? This is basically the risk that is there fundamentally with the business, right? Or fundamentally there. In terms of mathematically putting beta is basically the covariance between the stock returns and the market returns divided by the variance of the market returns, right? It also tells you basically how risky is your particular security compared to how risky is your security compared to the market generally, right? A beta of, let's say, 1.5 times means that your security is 1.5 times more risky than the market, right? Or it's you can just say the risk from the market is 1 and for your security is 1.5, so your security is more risky than the market, right? Now, how do we calculate the beta for a private company? Obviously, we don't have the stock returns data for the private returns for the private companies to get this calculated, right? So what we do is we find out beta for comparable companies, beta for comparable company, and then unlever unlever the beta, unlever the beta using the debt equity of comparable company, using the debt equity of the comparable company, and then you relever the beta using debt using the debt equity of your company, right? So this is how we calculate the beta for a private company. Find out a comparable listed company and then do it for your own stuff, right? This is also called as asset beta. This is also called as the asset beta, right? So you unlever using the debt equity of the comparable company and then relever it using the debt equity of your own company. The formula for unlevering and relevering is quite simple and it's available on the internet. Okay, this is one more question and then after that we take a quick shot tool to check with you if there are any questions. So, EV by EBITDA is a multiple that is used in valuation, and the PE ratio is also used in valuation. But EV by EBITDA is considered to be superior or better, a better multiple than the PE ratio. Why is it so? It is so because the EV by EBITDA excludes the impact of capital structure. Okay, and let me explain what I'm trying to tell you. Think of two companies, right? Exactly same companies doing similar or same business, similar amount of revenue, profits, everything, right? But there is a difference, right? One, the company one is that one company has financed itself majority with debt, and the other company has financed itself majority through equity, right? Now the value of the firm should not be different. Yes, value of equity, because they have financed it differently, could be different, but the value of the firm or the value of the business should not be different, right? If you use the PE ratio and do that, you will find that the value of the two businesses are different because they are doing same business using just a different amount of capital structure. It should not, the value of the whole firm should not be different. But if you do it using the PE ratio, you will find out that they are coming out to be different. Another way of looking at it is think of two companies. Okay, let's say two companies in the airline sector. One of them is buying aircrafts, right? To buy aircrafts, what it does is takes loans and then buys the aircraft. Another company which is basically leasing the aircraft, right? Taking it on rent, which is not putting a lot of capital into it, right? Their capital structures are different. Their profitabilities will be different. So the PE ratio would turn out to be different, and the valuation based on PE ratio would give a different valuation for the enterprise, right? But if you do it using the EV by EBITDA, it will exclude the impact of that capital structure, how the companies are financed, and hence it is considered to be a better multiple. The PE ratio will not have an impact in industry. The EV by EBITDA or PE ratio comparison will not have much impact in industries where you have got very little amount of debt or capital, right? For example, if you take the service industries, right? A lot of IT companies in India. So if you take those companies, you can value them based on PE or EV by EBITDA. It's going to give you a similar kind of stuff, right? Because there's not a lot of capital required. So any business which is capital intensive, EV by EBITDA is better than the PE for such businesses. Okay. Okay. So what is LBO? Leveraged buyout. So it's basically an acquisition of another company, which is done largely through debt, right? So you use a huge amount of debt to buy the company, and the debt levels could be about 80-90% of the value of the company. So that much is financed by debt. Only very little amount is financed by equity, right? This is what is called as leveraged buyout. In the leveraged buyout, what they do is the company that they are acquiring, they use the asset of that company as collateral to finance the debt, right? So this is what is a leveraged buyout. You are taking a huge amount of loan to buy another company. What are some of the drawbacks of the DCF? Now, there are a lot of drawbacks for DCF, but you know, uh, having after I list down all the drawbacks, it is still one of the best methods that is available for the valuation today, right? So, what are the drawbacks with DCF? First is if you have companies which have got whose free cash flow to the firm, right? FCFF is negative, and which is going to remain negative for foreseeable future. Sorry, is negative and is going to be negative for the foreseeable future, you cannot value such a company, right? You cannot value such a company. um, Second is if you have got a company, if you have company which is growing at a very fast pace, right? A company which is growing at a very fast pace, it will be very difficult to value such a company using the DCF model, right? Why? Because after a forecast period of, let's say, 5 to 10 years or whatever we do, generally we do it for 5 years. After that, we assume a particular growth rate which is not a very high growth rate. You cannot consider a very high growth rate. So we have something called as terminal growth rate, and typically we consider the terminal growth rate between 2.5% to 4%, right? There could be companies, for example, we have this company in India called DMart, right, which is growing at 25-30% for a long time, and it is expected to keep growing at that rate for a long period. So if you just forecast for 3 to 5 years and then take a terminal growth rate of 4 to 5%, the valuation is going to be coming out to be very small. What is the alternate is to forecast it for a longer period, right? So some of the analysts will go ahead and forecast for such companies for 25-30 years, but the problem with such a forecast is that we do not have visibility even for 2 years, 3 years, right? How will you go ahead and forecast for 25 years? And in 25 years there are so many variables that could change. The business could change, the business models could change, the company itself could change a lot. So it's very difficult. So if you have got a company which is going to which is growing at a very fast pace, the valuation that you get from DCF is very small or very low. So this is another one. The third drawback that I'm going to mention here is that the 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 DCF value of that particular firm is dependent or is very sensitive to two numbers, right? It is very sensitive to the terminal growth rate, and it is very sensitive to the beta values, and both these values could be taken differently by different company. Now what happens here is, I don't have the numbers to show you, but when you do the DCF valuation here, you will realize that the explicit forecast, majority of the time explicit forecast will only give you about 20% of the value of the firm. 80% of the value of the firm will be coming from the terminal value, and this terminal value is very sensitive to these two numbers, or rather to say the terminal value is very sensitive to the terminal growth rate and the weighted average cost of capital. And the weighted average cost of capital is very sensitive to the beta values. So the DCF terminal value using the present value of a growing perpetuity would give you a huge amount of sensitivity to the terminal growth rate and beta, right? So these are some of the drawbacks of the DCF model. Now, as I said earlier, also, even though there are a lot of drawbacks with the DCF model, yet it is one of the best, or it is the best method that is currently available for us. This brings us to the next question. So we said that, okay, if you have got a negative free cash flow, how will you value the company? You could use a relative valuation methodology. If the company has got positive EBITDA, at least you can do the valuation on the EBITDA, EV by EBITDA, or alternatively, you can use the price to sales ratio, right? Price to sales, right? Sales will definitely not be negative, right? So you can use for similar companies, find out the price to sales and then use that price to sales multiple to value your company. There could be other ways of valuing the company. For example, when WhatsApp was acquired by Facebook, right? They broadly seems to be have valued based on the value of each customer, right? And they paid for whatever was the value for each customer multiplied by the number of customers that were there. What is the difference between the free cash flow to the firm and free cash flow to equity? To just simply tell you, the free cash flow to the firm is the cash flow available for both equity and the debt holders, right? This is for equity holders and the debt holders. This is only for the equity holders, right? There are various formulas used to calculate the free cash flow to the firm. I will just tell you one of the formulas that we generally use. So free cash flow to the firm is the cash flow from operations plus cash flow from investing, right? I have done plus. Generally the investing cash flows are negative, so this will become cash flow from operations minus the cash flow from investing. So this is the free cash flow available for distribution to both the debt owners and the equity owners, right? From here, if you were to derive the free cash flow to equity, right? Okay. From here, if I were to derive the free cash flow to equity, give me a minute, guys. Okay. So if I were to use to derive the free cash flow to equity from here, okay, doesn't seem to be right thing. So if I were to derive the free cash flow to equity from here, then what I will do is from this I will also subtract the interest, right? The interest, and I will also subtract the net changes in the debt. net changes in the debt. Right, so two things that I will adjust from here. Those two things are related to debt. One is the interest, so I will subtract the interest, and I will also plus minus the changes in the debt, plus minus the changes in the debt. So that will give us the free cash flow to equity. When you are using the free cash flow to the firm, you will use the weighted average cost of capital to discount it, and what you will get is called as the enterprise value. If you are using the free cash flow to equity, you will discount it using the free cash flow. You will discount it using the cost of equity, and you will directly get the equity value. So, some people do the calculation using the free cash flow to equity, but most of the people will find out the enterprise value, and then from the enterprise value, adjust for the net debt to get to the equity value. So like I was saying, the free cash flow to the firm, FCFF, is calculated basically cash flow from operations plus cash flow from investing. From here, if you were to derive the FCFE, right, free cash flow to equity, you will do FCFF, right, minus the interest paid, right, minus the interest paid, and then plus minus changes in debt, right. If you are using the FCFF, free cash flow to the firm, then you will discount it using the weighted average cost of capital, and what you will get is called as enterprise value. Enterprise value. From this, you will adjust net debt, right? You will adjust the net debt, and what you will get is then the equity value. When you're using the FCFE, then you will directly discount it using the cost of equity, right? You will discount it using the cost of equity. KE stands for cost of equity, and then you will directly get called what is called as the equity value. You will directly get the equity value. So earlier we'll get the enterprise value. From there we will adjust for net debt and then the equity value, and then here you will directly get. Most of the people will be using this one, and some people will still be using this one. None of them, I mean, both of them are correct, but the enterprise value is considered to be more correct than the equity values directly. Okay, so this question relates to how do we find out the weighted average cost of capital? So when we find out the weighted average cost of capital, right, it is weight of equity into cost of equity plus weight of debt into cost of debt into 1 minus tax rate. I'm assuming we only have the equity and debt in the capital structure. We don't have preference shares or any other instrument that is there. So when we calculate the weights of equity, right, weight of equity is found out as value of equity divided by value of equity plus value of debt, right? This values of equity and debt that we take the market value of equity and we take the market value of debt, right? Most of the times what you will see is that debt is not listed in the market. So if the debt is not listed in the market, you take the book value of debt. You assume the book value of the debt equal to the market value, right? If you are doing it for private companies, then what we can use is something called as the target capital structure. So most of the time the company or that particular industry will have a particular capital structure, right? A particular debt equity ratio that is generally there in that particular industry. So you can use the target capital structure for that particular company if you can't find the market values. Okay, so the target capital structure is considered to be the best way to find out. But if it is listed company, we use the market values of equity and market values of debt to find out the weights. We do not use the book value. Book value is the last resort. If we don't have anything else, then we may fall back to book value. This is also a question that has come up in the recent interviews. The reason is that there is changes to the accounting standard related to leases. right? A lot of time earlier when companies had leases, they used to go for the operating lease, and then the operating lease was not shown in the balance sheet. What was shown is only the rental expenses that was coming out from the operating lease, right? But now with the changes, it's very difficult to classify anything as operating lease, or rather in most of the cases you will have the assets and liabilities on the balance sheet, which was not the case earlier. So how do you treat the leases in the financial statement or in the valuation? Basically, you treat the lease, right? Lease liability that is there, that is treated as debt, right? That is given a similar treatment as the debt. So whatever treatment you do to the debt in the DCF model, you give the same treatment to the lease liability. So lease liability is considered to be debt in the books of accounts, or sorry, is considered to be debt or like debt in the DCF model. Another one interesting, because a lot of people may not know about the PEG ratio, right? The price earnings to growth ratio. Price earnings to the growth ratio. So why is the price earnings to growth ratio better than the PE ratio? To give you a simple example, consider there are two companies A and B, right? I give you this information that PE ratio for A is 20, or let me just make it more elaborate. So let's say the price for company A share is 100 and price for company B is 110, right? The EPS for both the companies is 5 and 5. So if you calculate the PE ratio, price earnings ratio, what you will realize is this is 20 and this is 22, right? So the general understanding is a P ratio. A P ratio of a lower P ratio means that the company is undervalued, or rather the other way. If the P ratio is higher, then the company is assumed to be overvalued, right? Now this is the situation. I didn't give you one more information that is there. I'm now adding that information. The information is that company B is, even though they are similar at this point of time, company B is expected to grow much faster than company A, right? So company B is expected to grow much faster than company B is expected to grow much faster than company A. Now you are ready to pay more for company B. You are ready to pay more for company B because it is growing faster, right? So the PE ratio does not take into consideration the growth rate of different companies. If the growth rate of two companies are different, you cannot use the PE ratio to compare them, right? If the growth rates are same, then you can go ahead and use the PE ratio to compare them. So what is the alternative to that? What you do is you divide the PE ratio with their growth rates, respective growth rates, and then calculate a new ratio which is called as PEG, price earnings to growth ratio. And the interpretation is very similar to the PE ratio. So a company which has higher PEG, right, price earnings to growth ratio, is considered to be overvalued. A company which has got lower PEG, price earnings to growth, is considered to be undervalued, right? So this is how you can look at the PE ratio and the PEG ratio. The next one is accretion dilution analysis. What is accretion dilution analysis? We do accretion dilution analysis when we have a M&A, right? So when you are kind of acquiring another company, right, and you want to understand that after acquisition, what will happen to my EPS, right? Whether the EPS of the combined entity be accretive for my investors, or will it be dilutive for my investors? That is called as the accretion dilution analysis. And this is one thing that it's not obviously the major issue that people look at, but this is one of the things that companies look at when they are acquiring another company. They look at after acquisition what happens to our EPS, right? Whether the earnings per share for the shareholders is going up or down, right? So this gives them an idea of how much they are paying for their new company. As I said, not necessarily the best way to do the final analysis, but this is one of the things that the companies definitely do when they are doing M&A. Right. For relative valuation, there are various multiples. It is asking us to list down a few multiples. We already know a few, already discussed a few. Price PE ratio, right? The other one is EV by EBITDA. EV by EBITDA. You could have price to sales ratio, right? You could have price to book value, right? Price to book value. Now, different multiples could be used for different industry, right? So for let's say power generation companies, we calculate something called as NPV per watt. NPV per watt, right? So different industry could be different things. EV by EBITDA is a very um, is used of, in a large way for most of the capital intensive companies, right? The price to sales ratio, if you look at, is slightly not such a good ratio, because the price here belongs to the equity holders, while the sales, from the sales you will pay to the equity holders, from that you will also pay to the debt holders, from there you will also pay taxes, right? So in that sense, not such a good ratio. But like I said earlier, if you have got companies whose profitability is negative, the cash flows is negative, then you can use the price to sales to value such a firm. Price to book value is used for banking and financial institutions, right? Price to book value. So these were the questions that were kind of related to what we say, the valuation concept, the concept in finance. Obviously, this is not an exhaustive list, right? There could be so many such questions that could be there. We're trying to just create a few of them to you at this point of time. We'll try and create an exhaustive list at some point, and say send it across, or at least put it on some website, so that you can have a look at it. So these were the questions related to finance and valuation. The next set of questions, like I said, could be based on uh, what you call as guess estimates. Right. Now, remember that there is no particular right answer to these guessed estimates, right? There could be various ways of arriving at these estimates. What they are telling you, or what they are trying to understand, is if you are put into a situation, a difficult situation like this, do you have enough aptitude to come out of them, or you understand things well, so that you can come out of them. So this is one question that I have seen a lot of time being asked. This is also one I was asked a long time back during my first interview. It was recently asked to a couple of my students who are there, or who went for a investment banking role. So how many letters do you have in your resume? Now this started with me saying that, okay, tell me, did you make your own resume? I said, yeah, obviously I made my resume. So they said, tell me how many letters are there on your resume. Now they're not even asking me how many uh, words are there, right? And I don't currently have, unless I remember and I have counted it on word, how many letters and words are there. I don't remember. So if I am put into that situation and I don't know how many letters or words are there actually on my resume, I can just say that, okay, so my resume is one page. One page means we will have about 20 lines in the resume, right? There will be 20 lines, and each line would be about 5 to 7 letters. So if you assume 5 letters or 6 letters as an average, sorry, 6 words as an average, and each word will have approximately 5 letters. So 6 into 5, which is 30 letters per line, and you have got 20 lines, so it's about 600 letters, right? So as I said, they're not looking at the right answer. They're not going to go and check what they are trying to see is that if you are put into such a situation, or if you are asked to guess, will you be able to estimate that stuff? This is one question. The other one, which was again recently asked, how many electric vehicles are there in India? Now, how many electrical, and that two wheelers, is difficult to say, right? How I would approach this question is say that, okay, when I go out on the road, I see that out of every 10 vehicles, there are 3 vehicles which are electric vehicles, right? Out of the 10, there are 3, so which is about 30% of them could be, yeah. But I am in a urban location, and the urban location, the adoption of EV is slightly higher than the rural areas. So you know, potentially in the rural areas could be lower. So based on such stuff, we assume that it would be about between 15% to 20%, or 30%, or 25%. Again, as I said, they're not necessarily looking at the right or the wrong answer. What they are looking at is how you arrive to that particular answer. These are common these days in the interview, very common in the interview, not just in investment banking, equity research industry interviews, but most of the finance interviews. There could be so many variants of this that could be there. So you can't prepare with all of them, but what you need to prepare is what are your options to find out. The next one, sorry, yeah. The next one is how will you forecast employee cost for a service-based organization? Right. Again, is not necessarily a guess estimates, but it is trying to understand, how you understand the numbers. It is asking you to broadly, uh, divide the cost into its drivers, and forecast those drivers. So what you are going to say is that, okay, to forecast the employee cost, we would need to understand how many employees are there, what is their salaries, what has happened, or how many new employees are going to come up, what is the level at which we are hiring people. Are these people hired at the lowest level, or at the mid level, or at the higher level? Plus then, what you need to also understand is how many employees you need to really hire. For that, you need to understand is what will be their productivity, right? How much work can they handle in the near future, and for that much, if you are forecasting x amount of work, for that how many employees will be required. So you need to forecast, you need to break it down into various metrics, like the number of employees, which will then be based on what is their productivity levels, right? Whether the productivity is increasing or decreasing because of certain exercise that you have done. So let's say if you do a lot of training, there are chances of productivity increase or decrease. Then you also need to know is at what cost are you hiring the new people, what hikes are you giving to the existing people, to forecast the cost. So you need to break it down. What they are broadly looking at from you is to break it down into what we call as drivers, or some people will call it as the key performance indicators. So one which you like most. So they will ask you of which company you like most and why, right? Obviously, the more important question is why. So you can answer it in various ways. Obviously, there's no standard way of answering it. But what you should talk about is not just the generic stuff, right? What do I mean by generic stuff? I will give you an example. So we have this company called DMart, right, which is Avenue Supermarket Limited, and this company is into retail, right? Organized retail for a long time now, and it is one of the most profitable companies in the retail sector in India. Now, so if I have to say I like DMart, now why do I like DMart? Not because it is most profitable or it is most valued, right? I like DMart because how the business model works. right? If you see, they have a business model where they go and not open their stores anywhere and everywhere. What they do is something similar to a hub and spoke model, right? What they do is they open up a large fulfillment center, and then they connect different dmarts. So they identify location which can be connected with this fulfillment centers, and go up to those location to make to get the dmart, right? To set up new stores. They are also the lowest cost producer in terms of the cost that is there. Not the selling price, I'm talking about their own cost. So their cost is quite low, because the way they have structured their business, they go and not open in the center of the city, they go into the outskirts, where the rentals or even the buying is lower. Also, they do not they do not rent out. They most of the time buy the land and then make their own dmart. And over the period of time, obviously, because the locality grows, the value of that particular land also is growing, right? So these are the things that you will have to talk about, not just the general stuff saying that, oh, it is most profitable company. You will have to go slightly more deeper and say why it is the most profitable company, or why according to you it is the most profitable company, or what is it doing differently from its competitor to be the most important or most profitable company, right? So you have to go a bit more deeper than just saying I like it because it is most profitable or stuff. Okay, now these are the questions that would be generally asked. I have added a few questions related to Excel also. Tell us an alternative to VLOOKUP function. So all of us who have used VLOOKUP know that there is limitation with the VLOOKUP function, right? The limitation is that you should always have the selection on the left hand side, right? You can select only from here. So if you have got a common column which is on the right side of the one that you want as an output, you may not be able to use VLOOKUP. You may have to cut and paste it to that side and then use the. Earlier we used to replace the VLOOKUP with a function called index match, which is a combination of two functions, index and match. Now with XLOOKUP coming up, we do not need the index match also. XLOOKUP is good enough to take care of the VLOOKUP of the VLOOKUP function, or whatever is the drawback of the VLOOKUP function is now being taken care by the XLOOKUP function. Tell us about new functions, the recent functions that are there in Excel. So again, a question on Excel. It is just trying to understand whether you are updated or upgraded yourself or not, right? I'm not answering that one because that keeps on changing